Dividend Investing by Brandon Scott. So he starts off the book by basically saying investing in stocks is one of the most lucrative way to make money. He goes on and explains that bonds and CDs now are terrible and have one of the worst rates ever, and that stocks that pay dividends are typically safer forms of investments, or at least safer stocks to invest in as well, and that this is a great way for you to invest your money. He then goes over a general overview of the stock market history and basically how it started, and how these exchanges that people list their stocks on are there to help protect the people from these companies, to make sure they have accurate information so that when you're investing, you're not getting into a company that totally lied about everything. And of course, he gave some examples of how some companies do slip through the cracks and can do this, but generally it's so well regulated that it doesn't really happen anymore. He then explains what a dividend is and how it's a payment of the company's profits to the shareholders, and that they're typically paid out every quarter, with the dividend yield is being the percent payout for each stock. And that the main thing you need to know about the ex-dividend date is, in order to receive a dividend, you just have to buy the stock before that date. And that if you are planning on getting out of a stock, just wait one more quarter, or at least the rest of the quarter, to get paid out your dividend, and then when that happens, then sell out on the stock. And that you can figure out the payout ratio by having the dividend per share divided by the earnings per share. And this is basically to tell if the company can pay out these dividends, and if the ratio exceeds 100%, more than likely they're not going to be able to pay it out, and they'll either cut it down a lot or just not pay it at all. And that when you're looking for a company to invest to that pays a dividend, try to look for growth in their dividend payments every single year. But be wary, because there are a lot of companies out there that offer extremely high dividend yields, and these are typically bad stocks, and they're just trying to entice you into buying the stock. And that the stocks that do this are usually under $10 a share. And that when you're doing dividend investing, try to stick to blue chip stocks instead. Look at the history of the dividend payments and how they handled past economic downturns with their dividends, whether or not they cut them, kept them the same, or even raised them. He said, beware of stocks that are under $30 a share. Not all stocks pay a dividend, and the reason why, if they're not paying a dividend, they're probably in an aggressive growth state, and they won't be able to do that. One of the websites he recommends you use is dividend.com to find dividend paying stocks. He then goes on to explain that in the long term, pretty much all stocks go up, and that day traders or people who look for short-term profits usually lose their money in the long run. And that dividend investors only sell when the company starts to underperform. And that you, as a dividend investor, should always be buying more stock and reinvesting your dividends. Doesn't matter how old you are. However, the older you are, the more aggressive you're going to have to be with this trading format. And that compound interest is your best friend. And that adding in dividends on top of that can make your portfolio size grow to huge amounts of numbers. And that the magic with stocks is not only can you make money with dividends, but typically you'll make money with the stock appreciating as well. And the way to calculate how much money you want to make every single quarter is you take the amount you want, for example, $10,000, divide it by the share payout. Let's just say they're paying out $3.25 per share. You're going to need 3,077 shares of that stock. And let's say that stock is probably trading at around like more like $50 a share. You need about $153,000 and $850 more dollars on top of that. Sorry, I read that number so wrong. In order to make $10,000 every single quarter. And that does seem like a huge number, and that's because it is. He then goes over what drip investing is, that it's a dividend reinvestment plan, and you basically rebuy stocks inside the same company over and over again with your dividends also buying into that stock. And because you're doing it with a drip account, you can actually buy fractional shares. And over a long period of time, it actually really starts to add up. He then goes over market and limit orders, systematic and unsystematic risk. And basically what that means is, let's say you have a company in technology and you have Netflix. One of the risks being that, let's say Netflix is going down, but the whole sector as a whole is actually going up. It's an unsystematic risk because your stock isn't doing well based on the sector as a whole, but a systematic risk is where the whole sector is going down. So not just Netflix is going down, but the whole technology industry as a whole is. Next, he goes over dollar cost averaging, which in turns is basically like, let's say a stock goes down $10 a share and you bought it at 40, now it's at 30. To average your cost of how much you bought each share at, you'll buy more shares at $30 versus, your original purchase price of $40. And that downturns in the long run are actually your best friend as an investor, not for day traders. And one of my favorite quotes he said in the book is that day traders are absolutely full of it. Didn't have to include that in the book summary, but I just thought it was pretty funny. He then goes on to explain how diversity is key, and that if one sector runs into a problem, usually another sector is the solution, and they're doing really, really good. And diversifying helps mitigate losses and wins. He suggests that you invest into between 10 and 20 companies and to spread out your investment very evenly, but to invest in different sectors, not just different stocks. For example, you don't want to have 20 stocks in the pharmaceutical sector. Even though they're all different stocks, if that industry goes down, more than likely all of your stocks are going to go down as well. And that every single year you're going to have to rebalance your portfolio. And basically the risk, or the goal of this, is to keep risk in check. He then goes over the difference between growth and value stocks, and that every year you should check the health of the stocks that you're invested into, and that you should always focus on the good on your portfolio, not about the what if, like, oh, what if I would have invested in this? And that some things you can do if you don't want to do all this work is that you can buy dividend paying mutual funds if you don't want to have to find all the stocks. However, later on in this chapter, at the end of it, he basically says that buying into mutual funds is a waste of money. So just keep that in mind. And that there are 4 classes of mutual funds: stocks, growth, sector, and money market funds. Once he finishes this chapter, he talks about how ETFs are a better investment than mutual funds, and that recessions are typically over in 2 years or less. He goes over an IRA, real estate trust, massive limited partnerships. Of course, for the sake of this video, I'm not going to go over all of those, as they probably don't pertain to 90% of the people watching this video right now, since the title was about dividend investment. Finally, towards the end of the book, he goes over fundamental analysis. It was a quick one compared to other books. Basically, when you're doing a fundamental analysis, you look at the dividends and see if they're increasing their payments, check the PE ratio to see if they're overpriced, and obtain financial reports and go through them. And if you're invested into a mutual fund, read the prospectus so that way you know what you're getting into. And there are 7 major factors when looking into a dividend stock. Look at the earnings per share, their projected earnings growth, their PE ratio, their price to sales, their price to book ratio, their return on equity, and their dividend yield and dividend payout. And on top of all of that, you need to check the economy in that sector to see how they're doing. Always look at the news about your stock and check where they're headed. And if you're looking at a mutual fund, look at their year-to-date returns. So I hope you guys liked the video. I love making these. It really helps us out over here if you remember to leave a like, comment, and subscribe for more future content.